our next guest today is the most quoted source on ChatGPT for Canadian financial advice. So if you ever asked about investing, taxes, you're actually talking to this guy. And that is Jason Heath, Managing Director of Objective Financial Partners. Jason, thank you for being here, my ChatGPT friend.
Thank you for having me. And thank you, ChatGPT.
It's wild. So many people in Canada have been kind of talking to you for a long time now. Even when you Google stuff, you'll be coming out.
Yeah.
I saw an interview with you where you're looking for information and the source was you. So you were talking to you when you needed financial information.
I'm telling you, I have Googled stuff and I see an article I wrote like 5 years ago and I'm like, oh wow, okay, I did know that at one point, right? But I've written on a lot of different topics over the years for sure, Gary.
What do you think? Do you just go like, oh yeah, I'm smart. Yeah, I got this.
I used to be smart.
Yeah. I want to jump right into this because this podcast is coming off the heels of that Finfluencer piece I put out, kind of explaining all the predatory things that Finfluencers do and then some corporations do.
Yeah.
So people would have seen that. Now they're going to watch this because you wrote a piece on the Financial Post talking about Finfluencers as a whole, their effect on investing, some positive, some negative, but all of it was valid. I really liked it. You're fair. You're really unbiased, especially for someone who's with your accredited background. You would think that you would have just came out like on it, but you're like, no, you saw the bad points. I was impressed by that. Let's walk through sort of your criticisms and then I'll tell you my side of it. So you like kind of a list of them. So one of them was, and I have them in front of me if you want me to tee you up.
Yep,
so I actually, one of them was Finfluencers often lack proper credentials and regulatory oversight. So just expand upon that a bit. It's pretty straightforward, but
that is true. You know, to be honest, financial professionals often have impediments from going out and speaking on social media and putting things out there, particularly if they work for a big financial institution. It needs to go through compliance, and so you don't hear and see as many people out there in social media and even sometimes in the media who are financial professionals. And it seems a little backwards. I mean, those are the people that you figure should be out there and spreading information as opposed to less qualified people. But, you know, in recent years, there's just been such an explosion in the ability for anybody to put information out there on the internet and social media that there's a lot of uncredentialed people who are providing advice, usually investing. I think that's where it tends to be, as opposed to, you know, taxes or saving or financial planning, but a lot of investment advice in particular from people who don't hold proper credentials.
If you give bad advice, do you get potentially delicensed? Is that how it works?
Like, you can, for sure. You know, and I think that's part of it, that you've got risks when you hold certain licenses. You've got restrictions when you work for big financial institutions that need things that are approved by compliance. So, you know, when you don't have credentialing, you know, Finfluencers can go out there and they don't have the same sort of muzzle, I suppose, that a lot of financial professionals have. And that can be a bad thing, because they can say just about anything. And they, until recently anyways, I mean, there are changes that are coming, but until recently didn't really face any, you know, material consequences.
Yeah, I'll talk about that now on my end. So there's a ton of compliance stuff that I have to adhere to on my end, only because I'm trying to do this above the board. We were talking off camera. I was giving you sort of insights into my background. I have the 15 years of advertising, but I have over 5 years in capital markets. So I came from compliance. Everything had to be compliant friendly because I was dealing with CEOs and whatnot. So I was sort of used to the stuff that you would have to deal with as far as compliance, but for digital advertising. So I sort of took that approach, applied it to the YouTube channel. But in the end, it was a necessity because there's a ton of stuff. The Joint Canadian Securities Administration, the Canadian Investment Regulatory Organization, they're cracking down. It's the reason why I put that video out is because there's so many Finfluencers making people like me look bad that the government's getting involved, being like, wait a second, there's too much predatory stuff. So all your concerns were valid. It was anyone could say anything and there was no ramification. Now the ramifications are, especially if you have an audience, legal and financial. They're going to slap you with a fine and you're going to feel it. So on my end, as far as compliance goes, you'll see a lot of legal jargon on my videos now. So if I ever here's a good example. I work with a partner on our channel, Hamilton ETFs,
Hmm.
right? I own their ETF. This is not a plug for them. I'm just using them as a reference point.
Yeah.
But whenever I even mention them now in a video, I have to put legal stuff in the video. But this is not
Yeah.
sponsored. But they do partner with the channel because I do all this educational content. They help with the podcast and stuff like that,
Hmm.
right? So it's just like they're involved somehow. They paid for stuff, but they have nothing to do with this. But I did use their name in a video, just so you know, we have a working relationship with each other. So that's now above the fold. When you click on a YouTube video, you'll see that right there. It's all over the place. And then obviously when you do a sponsored video, in the first 30 seconds, it's sponsored. Hey, it's sponsored. Then there's another thing where you have to be openly transparent with people. I try to do positioning. So I'm never trying to look at this. I come across anyone like, hey, I'm a financial planner. That's
Hmm.
dangerous. I
Hmm.
never want to tell anyone what to invest in. That's dangerous.
Yeah.
I legally should not be allowed to, anyways, even with the new regulation. If you say, Jason, Gary, I have $50,000. What should I do with it? I go,
Hmm.
I don't know.
Yeah.
I don't know.
Me
Here's what
too,
index and
for what it's worth. It
yeah,
depends, you know?
I go like, well, here's what an index invest ETF
Yeah.
does. Here's what this kind of ETF does. I really try to stay away from single stocks
Yeah.
because everyone will lose their money on it if they're
Yeah.
not like a full-time investor. But it's just like, here's what everything does. You make an informed decision,
Yeah.
right? And then I have a marketing research background because that's all my job was, 15 years marketing research to be a good market. I used to use tons of marketing research when I put together these educational videos
Hmm.
where it's going through me, it's going through my research team. We're sourcing guys like you, right? Where now by time it gets to the public and I've uttered the words, it's been validated. It's the same critique. It's the same vetting that it had to go through when public companies were working with me
Yeah.
and they had to go and actually not get sued. So
Hmm.
we're using that same structure, then the content gets pushed out. And
Hmm.
even then it's like, oh, it's still off about something because something got updated the week after the video came out. So that you can't be 100% accurate.
That's it.
That's the procedural I'm using. Now, I wanted that across the board with all financial influencers.
Yeah.
How do you feel about keeping everybody to that standard? Like that should be the bare minimum, I feel, if you're going to be
Yeah.
giving out financial advice, because
Yeah.
I feel like financial advice can destroy lives if it's bad.
Oh, for sure. I think there should be disclosures, and there's a reasonably good chance if somebody is recommending a particular investment, especially an unregulated influencer, that they either have an interest in that investment or they're being paid by that company. So I think you always got to wonder what the conflict of interest is, and those conflicts should definitely be exposed. But I think one of the keys, and you sort of hit on this, is that to give advice to a broad audience, it's very difficult. Like, what should I invest $50,000 in? It really does depend. What's your time horizon? What's your risk tolerance? What's your tax implication? Which account should it be in? It's very difficult to give broad advice to an audience, or specific advice to a broad audience. And I think that financial advice really should be personalized. So you take everything with a grain of salt. You use it as an opportunity to learn, and just be careful when you hear things out there, whether it's social media or whether it's a hot stock tip from somebody. So
What do you think about an audience member? Let's say they use my channel as a entry level. I try to treat it more like an entry level. Sometimes the podcast, this is more advanced. So when people
hmm.
have got through my educational content, they land here, then they sit with an hour with us and they get into the nuances.
Hmm.
But what do you think of when you get a client? Let's say they've consumed my content, so they've got the basics of investing down. They understand what a cover call ETF and index ETF is. They understand the tax structure, TFSA, RRSPs. They've got all that information because they've got it from my channel. Is it helpful to you then when they come to you? At least you're not starting with scratch with a person. They have some semblance now how things work, how investing works, some semblance of what fits them, and maybe they can ask you more of the right questions when they're putting together a strategy rather than be completely blind. So
Yeah.
it's almost like they can come more prepared to you now. Be like, hey, wait a second, I've done some of my own research.
Yeah.
Gary he didn't tell us what to do though. He was very adamant. Now let's sit down. Let's really figure out, like, what do you feel about that?
So it's a great question, and my own experience, like over my career, I've worked with a lot of different clients, a lot of different types of clients. And there are people who are very well versed. Like you said, I would say that most average Canadians don't know what a covered call ETF is, for example. But
Yeah.
there are people that are more sophisticated and work with a financial professional, and the conversations are very different from the average client, or very different from somebody who doesn't know anything. And over the years, I've certainly met a lot of people that are very smart, very good at whatever it is they do for a living, but they don't know anything about finances. And some of them admit it. Some of them you kind of infer it just based on your conversation. And, I don't know. Even people that are not very sophisticated, I think if you're a good financial professional, you can find a way to explain things in a way that works for them. So there's definitely benefits to being more educated and more sophisticated. I think people who know more tend to make more confident decisions.
Mm.
And that really makes a difference. The more you know, the more you're able to ask questions of professionals, the more you're able to establish what your framework is, whether it's investing, whether it's saving, whether it's giving money to your kids. What are your morals? What are your rules around financial planning and investing? And the more you know, the better. But you see everybody out there for sure.
The next question I want to go into a little bit, and we kind of talked about this, was potential conflicts of interest with sponsorships and affiliate deals. I'm going to expand upon this a little bit. So this isn't, and I'm going to explain the YouTube business a little bit to you, because when you create content, there's an expense tied to it. So I'm net negative on my channel. If you look at some of my editing, it's just like really good editing, all that stuff, right? So it's just like, all right, I'm just losing money on this bad boy, but it's fine, right? But then you have sponsorships where you go like, okay, cool, it can make up the difference ideally, right? And then I'm just really particular because I come from the advertising. I only work with people that I own their product or actually use it, have my own money on the line. And I feel like it falls into a basket of broad. So like the reason why I went with Hamilton is because they have covered call index funds that are the closest to how an index fund performs. Like they're super low yield, like they're very low risk for that space. And I go like, okay, this is what I would do because I don't like to go over specific yields. I'm like, so I feel like if it's going to represent my brand, it's what I'm comfortable with. So I just
Right.
don't go
Yep.
near it. That's why so I kind of adhere to that. But there's still a monetary aspect of it where it costs money to run a channel. When people look at my YouTube channel, oftentimes my marketing agency will be like, yeah, I like how your video's edited. Could you do that for my lawyer's office? We're like, yeah, sure, we can do all that. Like there's stuff like that
Yeah.
happens, right? So there's a lead generation pipeline. Ben Felix, similar to you, same kind of credentials, financial planner type thing. He's giving great information out, but that's not, and he's a nice guy too, as well. But in the end, it's still a lead generation funnel for him. He has PWL capital and people, so he still has a good advertising budget. It's still going from his video to that. So people don't understand, no matter what in YouTube, there's a monetary component to it.
Yep.
To reach a certain success level with YouTube, you actually have to have that, or else you just can't churn out content. You can't dedicate 30 hours a week to something. You have bills to pay. You actually have to monetize it. It's just, I'm more about how do you monetize it in a non-predatory way. So affiliate sponsorships, you're not giving a link to some scammy crypto scam thing. You're not going with sponsorships that are going to just take your money for a pump and dump scheme. You're doing stuff that actually and Ben's really, he believes in PW Capital, right? He's one of the main guys there, right? He feels very good sending people over there because they know he's going to end up better. I feel good sending people over to Hamilton because I know they're in good hands, right? So like, you kind of got to root it in that. So tangent, there's a good and bad way of doing it. There's a light side of like Ben's doing, the good side. He's an actual financial planner like yourself. And I feel like there's a good side of how I do it as an actual Finfluencer. We kind of represent that. But then there's just a gong show of predatory, probably in your space too, that I just haven't seen. Then also, and then talk about that a little bit.
Yeah. And whether it's Finfluencers or professionals, I can't remember if I alluded to that in the Financial Post article that you're referencing or not, but there are good and bad financial professionals, and most people I would say are good and put clients first and do the right thing. But I've met a lot of bad professionals who do not put clients first and who do not do the right thing. And the financial industry, even though it is regulated to an extent, there are things that happen that aren't good either. And in that article on Finfluencers, I think that's why I took a position that, Finfluencers, there's some good, there's some bad. Professionals, there's some good, there's some bad. That's sort of how the world works, right? And I think that particularly if you are absorbing content, whether it's from professionals, whether it's, from unregulated Finfluencers, you need to do your due diligence. You need to make sure you understand what's motivating the information that's being given. You need to do your own research. You need to even use multiple sources. I think that's really important as well. I think it's okay for somebody to even have a financial professional they work with, but also have input coming from other areas, from an accountant, from an estate lawyer, from social media, from a book they're reading, from their friends, from their family. And that's how you can really inform yourself and develop your own opinions, because there's no right way to invest. There's no right way to save or to retire or to do anything for that matter. There's just varying degrees of right and wrong, and you've got to figure out yours.
Do you think your fee only structure helps you just focus on client results rather than some product upsell for your services? Like, cause you have a fee only structure, right? With your thing.
Yeah.
Can you talk about that?
Yeah, so we're fee only, or in recent years, what I'd like to refer to as advice only, meaning that we don't sell investments, we don't sell insurance, we sell advice for a fee, sort of like an accountant or a lawyer, whether it's an hourly fee or a flat fee or an annual fee for generally financial planning, which is a broad term, but I'd say it often focuses on retirement, whether somebody's 40 or whether somebody's 70. You're accumulating for retirement, you're decumulating in retirement. And it's an interesting structure because there are no conflict of interest from a product perspective. So there's
Yeah.
no reason that we would encourage somebody to invest over paying down debt, for example, or to shun real estate, a rental property, and invest in their RSP. We're sort of indifferent from the perspective that we don't get paid any more or we don't get paid any differently. I mean, at the end of the day, I always tell people this, and I think it's an honest way to put it. You've been honest with your motivations. You need to pay the bills. We all need to pay the bills. So even someone who's fee only or advice only like me, we're selling our services. We're trying to upsell our services to a certain extent. Everyone's selling, right? I think it is definitely a unique model here in Canada. There's not a lot of people who do it. Most people are trying to, I shouldn't say trying to. Most people are compensated based on financial products that you buy or don't buy. Some of them pay different compensation, so it creates these inherent conflicts that you need to be mindful of. Again, most people are great, most people are honest, most people are doing the right things. Not everybody, so just be careful.
I think when some financial planners look at fee only, they go, well, how do you get recurring revenue, right? You give such good advice, they never come back. But I have
Yeah.
a rebuttal. I have a rebuttal to that though, because when I created my company, the whole thesis behind it was create a product so good that people feel stupid for saying no. So I put no contracts, anything. There's no like, hey, marketing agencies, you pay an upfront fee, like 10 grand to get set up. And then you get locked into a 3-month contract. I was like, no setup fee, no locked in contract. You just get invoiced at the beginning of every month at the end.
Yeah.
And you want out, you want out. Only
I,
if that's
I
so
provide value or you don't pay. Yeah.
the end.
Yeah.
And nobody since I've started the company has been like, nope, everyone's just on renewals. And
Mm,
because I tell you, oh yeah, here's how you replace me, by the way. Here's how we're
mm,
doing it. Here's how you do it. The end. They're like, well, what? No, you're doing it already. They know we're getting the results. Because I remember the pain points through working with so many marketing agencies for so long. They're like, this is what everyone complained about. I'm just going to do it, give pure value, give them 1,000 ways to get out, give them everything they need to know, and then they'll just stay. And the same kind of, I feel, would go for your strategy is where if I go to you,
mhm.
you give me killer advice from like, this is amazing. It's all usable, practical. I can actually act on this and I'll be better off financially. Instead of me being like, I'm never going to go back, I'm most likely in my life going to have another
Mhm.
major financial decision,
Yep.
right? It's good no matter what it's going to, especially if I'm coming to you already, I'm already
Mhm.
thinking like this. Who am I going to again?
Mhm.
You, right?
Mhm.
And I will pay whatever the rate is because I know it's good. I will keep going to you. Instead of removing recurring revenue, you've locked it in.
Hmm.
You've just
Hmm.
locked in, and then they're just going to keep coming back,
Yeah.
only because you're just giving such high value. And I think when you are confident in your abilities, you're confident in your skill set, you can do that. And that's
Hmm.
why you can do fee only. It's because you're like, I'm good at this. I'm going to give good
Yeah.
advice to these people. They can act on it. It's practical, it's functional. And they'll just come back when they have another major life decision or financial decision. They'll come to me because they know at least they'll get something they can actually use. What do you think of that breakdown? I know I'm assessing your business structure,
Hey,
but what do you
look,
think?
I think you've hit the nail on the head. And, we've got clients, certainly I've got a lot of clients that I work with year in, year out. I'll meet with them every January.
Yeah,
Some of our clients, we do their income taxes as well, which is something you have to do every year. You don't have to do financial planning every year. But you're right. There's always those people that you met with 5 years ago that come back 5 years later because there is some sort of a life change, or there is some sort of opinion needed on something. Most people come back eventually. And it's really funny, Gary. I'll tell you, the people that I would have pictured would be ongoing clients and work with you every year that were like really complex, where there's so much you can do with them. Sometimes those aren't the annual clients. And then there's other people who have what we might consider to be relatively straightforward financial affairs. And those are the people that you've worked with every year for 15 years. And
yeah,
maybe you're not moving the needle as much for them in a measurable way in terms of tax savings or, investment outcomes, or things that you can calculate mathematically, but it's peace of mind.
that's what it is.
Oftentimes, Gary, I'll tell you, it's couples where they'll be like, so I haven't mentioned this to you, but, and you're like, oh, geez, I'm going to be in trouble. I hope it's, it's like it's like you're a therapist. You're forcing stuff to come out in couples financial therapy, eh? But there's, there's a value, and for some people it's annual value. For some people it's occasional value when life events occur.
I want to. A lot of people watching this are DIY investors, right? So they might maybe they'll go to for a consultation once in a while, but for the most part, they're going to try to do them themselves. What do you feel about this in the last 5 years? This wave of do-it-yourself investors. I feel like we're talking about this off camera. The
Mm-hmm.
Finfluencer kind of movement had a big part of that.
Mm-hmm.
Obviously, COVID had a big part. Everyone's at home. They got these stimulus checks. Apps came out. So you saw the markets go crazy because everybody was just buying the craziest stocks. I feel like people know a bit more now and they can make more educated
Yeah.
decisions, but it was wild. What do you feel about that influx of do-it-yourself investors, people just trying to do it themselves? Um, and I guess that's why I'm so passionate, because it's really kind of messing up lives, the misinformation.
Yeah.
I feel like on my area, at least my area, I should never be telling anybody ever, here's an individual stock.
Yeah.
You just don't. It's too many eggs. Like, I should never say buy this stock or whatever. Uh, I think I've only ever openly talked about one individual stock I buy, like aggressively open, and it was to show how much money I lost on it. I was like, oh my
Good lesson.
god! So I was like, okay, now they know. Stick to index funds, right? So I was like, it was more like and people know what I'm talking about. They're like, okay, it kind of like made people scared of doing it. But I feel like, at least from my position, I should really only ever be kind of, if I'm leaning like I can't give advice, more or less saying index funds, low cost expense ratios, your VFV in Canada, that kind of thing. And then
Yeah.
for covered calls, because covered calls can get kind of risky and kind of wild, and new products get developed,
Mm-hmm.
50 new products a month at this point. If you're going to do that, find the equivalent of what a VFV is for covered call space. Always go boring, always go safe.
Mm-hmm.
So I'm not
Mm-hmm.
saying any individual ETF. I'm just going to think boring and safe. If it sounds too good to be true, it is. And if the
Probably is.
yield is super high and you're going to be retired in 1 year, you have $250,000 and you can retire off of that. No, 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 no. That's not how it works. Like, that's kind of the advice I would give, at least
Mm-hmm.
for anybody, like very vague, but I think that covers most of the mistakes. What do you say to DIY investors and stuff like that who are just adamant on this?
Look, I think that DIY investing, the good thing is it's easier to do now than ever. It used to be, 40 years ago, it was really hard to buy individual stocks. It was expensive. You need to have a ton of money to invest directly with a stockbroker. You always had something in between you and the stock market. And now it's right there. It's in your hands. It's low cost. It's easy to do. pros and cons to that. The con, the negative, is that I think in recent years, markets have been pretty good, especially the last couple of years. There's been some ups and downs, but it's been mostly up. A lot of people, I think that gives them confidence that they're making smart decisions when meanwhile they've just been in the right place at the right time with markets going up. But I'm very much like you. I think that if somebody is a self-directed investor, most DIY investors should probably be buying exchange traded funds. They probably shouldn't be buying individual stocks. Even the professionals that are buying individual stocks, whether it's financial advisors, whether it's mutual fund managers, whether it's hedge fund experts that wheel and deal and buy and sell and spend all day doing it. When you look at the statistics about the winners versus the losers, most people underperform the market taking an active strategy. So how a self-directed investor who has to go to work, has kids, has aging parents, has whatever that's distracting them, they're not paying attention. The likelihood of them being the ones they're going to beat the markets by buying individual stocks, unlikely. So I definitely lean towards exchange traded funds, or if you are going to buy individual stocks, use a combination of strategies, like have an ETF or a couple of ETFs as your core, and then build around that with a few individual stocks if it's something that you really want. You can't get yourself in that much trouble. And be careful about buying only a couple of stocks. You need to have many stocks to have proper diversification.
Yeah, there's a couple of these are vague rules of don't go over the 5% rule. Try not to go over 5% of your portfolio on an individual stock. Try to anchor your whole portfolio with boring index funds just so you have it there. So you can just lock in a retirement. Like if you got TFSA, just put something, especially if you're young, buy an S&P 500 thing and just keep contributing and then check back in 30 years. That's like that's the easiest way. But then even with individual stocks, like stay away from penny stocks, stay away from get rich quick schemes. I kind of a simple rule is like maybe just look at companies that are on the S&P 500, look for companies that are maybe there's a bit of a market crash and you're like Google anyways, and Google is part of your ecosystem and it dropped by 5% and you're already building that position as 5%. Oh, it's a little bit of a sale and you expect to hold Google in 20 years. It's like, there was this one rule I would apply where if I wasn't comfortable putting 95% of my net worth on that stock, I don't buy it. Even if I was going to invest $1 into it, that eliminates everything. You're like, and you immediately just get tight. You go like, never mind. You're like, okay, but would you feel 95% of your net worth on like a VFV or VOO if you had to check back in 30 years? Yeah, you could put that money on it and you feel very confident in 30 years, you'd have more money than what you put in. I what do you think about this? I feel like early on when I got into investing, this was over a decade ago, I suffered from the Dunning-Kruger effect where I knew just enough where I thought I knew a lot, right? And I made dumb decisions. And now I check myself on that. So when I feel like I got this figured out, I go, I'm suffering from the Dunning-Kruger. I just know just enough to feel like I know enough. I feel like what happened in 2020 in the markets, all the money came in. You had the giant rally, and we've been in such a great market. It's up 20%, it's up 25%, all these crazy numbers that aren't realistic long term, that I think a lot of people have been lulled into a false sense of thinking they're better at investing than they really are. They're suffering, no insult, from the Dunning-Kruger effect, where they know just enough. They watch enough YouTube videos, enough that we're like, now I'm a day trader, now I'm a stock picker. And they're doing that. Wait till the market corrects. Wait till it doesn't work out. Like wait till reality hits. I think that's what's happening now because it's been about 5 years. They've seen enough gains where I think people are taking more risk. And another part of why I put out that video, just like put the brakes on everybody really, really quickly and go just stick to what was working. You will not get the 25%, 20% return on the S&P every single year. You get a 10% average annual return because some years you get 2%, other years you get 20, and then you get that average of 10. That's what it really looks like. It's not like this smooth sailing. What do you feel about my assessment that I myself suffer from Dunning-Kruger effect whenever I think I know too much? I just check myself going, you're missing a whole lot here. I tell myself that now, and it stopped me from making a ton of bad mistakes. And do you think people are suffering from that? We're in that cycle now where...
Oh, sure. I think sometimes people even don't have a good perspective of absolute and relative returns. Somebody could say, oh, I was up 15% last year in my stock portfolio. Oh, the Toronto Stock Exchange was up like 25% last year. So you had a good absolute return, but you had a poor
Yeah.
return relative to, an index if you're talking about a Canadian stock portfolio.
Yeah.
So I think that um, one of the things about investing, particularly if you start young, is as you start to make mistakes, as you start to see market downturns, it's helpful. Sometimes I actually hope for market downturns so people can learn the fear of seeing stocks go down 20% and then
Yeah.
seeing stocks recover and go, oh, okay, this is what happens, right? Okay. Because then next time they feel more comfortable doing it. And
Yeah.
sometimes your biggest mistakes are your things that stick with you, help you avoid issues and problems in the future. And it's one reason that I think more mature investors who are closer to or into retirement have to be really careful. There's a lot of people who want to move away from working with a financial advisor. They're paying 1%, they're paying 2% in fees. They want to save that. They want to manage their own investments. If all of a sudden, you've seen a good year or two the last couple of years, you've learned a little bit, you think you're going to manage your own portfolio, you got to be careful. There's a good chance that at retirement, you've got the most money that you will ever have, and the mistakes are very material. And if you haven't really paid attention, you haven't really watched the markets, you haven't really seen what it's like to make a mistake, that's not when you want to make a mistake with your portfolio. When you're 25 and you mess up and you put $500 in a penny stock and you lose it all,
Yeah.
lesson learned. You're probably going to avoid it in the future. So that's the other thing. You got to be careful the age and stage you're at about when you learn those mistakes.
Let's talk about that a little bit. I get sent a lot of people's just portfolios and stuff. And like I said, I can't tell people I'm not allowed. I can't be like, here's what you do with your portfolio. But I'll just talk about a trend that I see. A lot of people near retirement or in retirement, I often feel, and this is actually a result of YouTube. I know for a fact because some of the stuff in their portfolio, I've seen videos that kind of talk about these ETFs
Mm,
specifically where I go, I feel personally that when you're near retirement or in retirement, you should de-risk your portfolio. It's
uh-huh.
like you can't mess around with that money now. Like this is what you got. Don't
Hmm.
have a ton of crypto in it or
Yeah.
something like that. It's like, what are we doing here? Right?
Yeah.
Let's
Yeah.
make this work. Let's make this work because it's got to last now. I get it when even me, like I'm 40, I got some crypto in my stuff, but I'm good. Like I can
Yeah.
do this kind of stuff. Like I'm fine. I can do all this stuff because like my risk profile and the money I have and my portfolio as a whole, it's not that big of a deal. But if I was in retirement and I was like, okay, now here's what I'm locking in, I really want to go through the steps now of de-risking, moving into safer positions or just whatever, building a stable portfolio with minimal swings or when corrections happens or drops happen, you're the least affected. You just get that nice baseline where you have predictable income, especially if you move into cover call ETFs, something like that, or a dividend heavy portfolio, because a lot of people do like to move into that in retirement. It's you kind of chart out what your monthly income is going to be without wild swings. What do you feel about my breakdown of that? Leave all the stuff to people below 40. Ideally below 30. I think even after 30, you should start de-risking. I'm only doing it because of my financial situation.
Mm-hmm.
But if I was in a more conservative financial situation, I would have de-risked a lot more as well by this age. But
Yeah.
under 30, high risk,
Hmm.
closer to retirement, really start looking at what's risky in your portfolio. And maybe if you want to keep them, but start moving into other positions. You don't have to sell stuff, but just stop contributing into one area and start going into more of a,
Yeah.
I don't know, less risky.
I'd say it really depends. There's a strange phenomenon I find with younger investors where they're encouraged to take more risk because you've got a longer timeline to retirement. But a lot of times, the money that you have in your 20s or in your 30s is money that you're actually going to use in a relatively short period of time. You're going to buy a car, you're going to pay for education, you're going to put a home down payment or a condo down payment, you're going to get married, you're going to have a child. And a lot of times people go from saving up a little bit of money, hopefully in their 20s, to being, broke or at least cash poor in their 30s because they put everything they've saved up into some of those other things. So I think that's the only challenge. You got to be careful when you're young. If somebody was I don't know, a renter and going to be a long time renter and they didn't need money for a long period of time. Yeah, okay, you get a long time horizon, you can afford to take on more risk. But sometimes young people have these weird life events where their time horizon is actually pretty short. So I think it's also important to determine that money that you're going to invest, whether it's that account, that next contribution, what's it for? what's it really for? And B, not, hey, I'm young and I've got 30 years until I retire, but am I going to need that money in the next 5 years? Okay, I might need to take a different approach.
Let's talk about young people a little bit. I just filmed a video this morning. It'll be out either before this podcast or after this podcast. And it was me comparing, because I've been actively looking to buy another home. Just I got 2 kids. I got another one on the way. I'm looking at real estate purely just so my kids have real estate, not as investment properties, because I don't see how I can make money. I live in Vancouver. I mean, how do I can't, nothing's in, no investment in real estate is going to make me money compared
Right.
to an investment. But I was doing the number crunching. That I'm sitting in the basement of my house. This is my office. It's been my office for the last decade, over a decade. But I bought this house without saying the number for the price of like a 1-bedroom condo today,
Wow.
right?
Yeah.
And I bought it making a fraction of the income that I
Right.
make today, but
Yeah.
because I could. It was very accessible for a guy who's in his 20s to buy a home in the area that I'm in, right? I wasn't in a fancy neighborhood, so it all made sense. Now I was doing the number crunching. I'm like, I don't know how a 20-something-year-old does it. And even
Yeah.
when you look at condos, I go, those look like money pits. When you
Yeah.
look at like the strata fee and everything, I'm like, even if you rent out your condo, you're in the hole. You're not making money off of it.
Yeah.
None of the math adds up until I start looking at interior Canada, like Alberta and
Agreed.
stuff. I work remotely. I don't know enough young people, just whoever comes on the podcast, right? My only young people I know is my daughter who's 4, like my son is 2, right? Right. So, but uh, now I'm just going to workshop with you. This is what it
Yeah.
is. This is a workshop session. I thought in the video, my solution was a lot of people work remotely. I've been working remotely way before COVID.
Hmm.
Maybe you should just move into interior Canada if you want to buy a home, and that's your best
Yeah.
opportunity. Because if you're on the coastal cities like Toronto and Vancouver,
Hmm.
I almost think you're better off if you're staying there. And this is just a numbers thing, because the numbers were jarring how different it is. Just renting and investing in the S&P 500. To
Hmm.
one caveat though, how many people could realistically invest every single month with that excess cash for 30
Just
years?
for
Very
fun.
small. I
Yeah.
think very small people have the discipline, because it only works if you have the discipline to do that. Right? I
That's
think
it.
most people fall into the camp of, oh, I'm just going to buy a car now with my excess money. I'm going to do all this stuff and just get kind of loose with their financial situation. But if
Yep.
you're highly disciplined and could do it, you're better off by 7 figures just
Hmm.
doing that if you're on a coastal city.
Hmm.
And then it only makes sense if you're on a coastal city, if you're in my scenario where you're willing to just not look at it like an investment and it's an emotional thing to give my kids a home in 30 years.
Hmm.
Like it has no other value. I gave you a lot there, but what do you think of the current housing situation for young people?
Yeah, lots to unpack, but I agree with you. Whether it's Toronto, whether it's Vancouver, a lot of other big cities that have come up a lot in price. I'm of the mindset that prices can't go much higher. You've got high real estate prices. You've got prices that have gone up. You've got incomes that have gone sort of sideways. It doesn't make sense for that gap to increase. And at some point, in order for things to get rectified, either incomes need to spike or real estate prices need to stay flat and catch up, or real estate prices need to come down in some of these markets. So, um, you know, I thought 10 years ago, though, that things were going to improve. I've got 3 teenagers, and I thought, oh, by the time they're, going off to university and they're going to be buying homes and stuff, everything will be fixed. It's not fixed yet. But I do think that your point about being a wealthy renter, I think you can be a wealthy renter. I think, rent is always going to be cheaper than home ownership. Mortgage payments and property taxes and repairs and everything is going to be more on a monthly basis. If a renter is disciplined and invests in low cost exchange traded funds, has a more aggressive asset allocation, I think a renter could be wealthier in the long run. In real life, it doesn't always work that way, but renting does not equal bad choice, does not equal, financial failure. There can be cases where renting can be better and where renters can be better off financially over the long run.
I think there's a social like stigma. Some people think that if you're
Yes.
renting, and it's like, no, who cares? I'm brown. That's like the worst stigma. It's like you don't have a house and you're an Indian guy. It's like, what are you doing with your life? It's like horrible to put on people. It's like you can make more money if you just
Yeah.
rent depending in some scenarios. There's another brown guy, Rami Seta or something. His whole marketing gimmick is rent and live the life you want to live. And he's doing really well. That's his whole angle. I think I'm a little bit more pessimistic. I don't think house price will they're dropped right now. obviously. Like they're down across the board, especially in Ontario. But
yeah,
I don't think over the long term it's like that trend, because you look at the charts on the map, income is going like this, right? Even if housing stays flat, 40 years later, it's going to catch up at it'd have to be
yeah,
flat. It'd be a flat
for a long
plus
time.
plus the spike, and no private corporation is going to be like, let's give you more money. That's
Yeah,
never going to happen, right? And the government's never going to be like, let's give you more money. That spike is never going to happen.
yeah.
And even if it stays flat, like no matter what, it's just never going to like tee up
Yeah,
to each
it,
other. Because
it
if
it could take a generation for things to be fixed. I think that's part of the problem. So
yeah, something larger would have to happen. That's why I'm sort of just like trying to get ahead of the problem for my kids. Being like, all
yeah,
right, let's just get them set up. Let's do it. But it's just for me going to be kind of a money pit. I'm just trying to break even
yeah,
for the whole thing. That's what I'm hoping on. Now,
yeah.
what do you think of then the TFSA RRSP? Just some basic financial advice there. Obviously, in Canada, I put out tax videos and stuff. I'm citing like I use ChatGPT for some of it, so I'm talking to you when we're putting together some of the research. But there's so much. Why do older people hate it so much? I get a lot of comments being like, it's a scam, it's a
Yeah,
scam, it's a scam. Where's the scam?
yeah,
It's you put it in, it's tax deferred. When you take it out, you get the income tax. Where's the scam happen? You know that going in. I like it for tax deferral in this
yeah,
point in my life. I almost think of the investment as like a secondary thing. I go like, oh, I take the tax deferral. It's just better than
yeah.
paying money to the government right now. And yeah, I even know going into retirement, I don't even think my income will be low enough to take advantage. But whatever, I just want to defer it right now. I'll deal with that
Yeah.
problem when I get to it. But what do you think of the argument against it? I still don't. Why are people angry? Is there something I'm missing?
No, no. I think a really good example is when you convert your RRSP into a RIF, a Registered Retirement Income Fund in retirement. Um, there's a minimum withdrawal that you need to take every year, and that minimum withdrawal has no required withholding tax on it. And the
Right.
fact that there's no tax on it, but it's income, it's kind of like going to work and having a job, but your employer doesn't take tax off. You're going to owe tax at the end of the year. So most retirees end up owing tax and then feeling bitter about it. Why did I put all this money in my RSP? Well, hopefully you saved this much tax, and on the way out, you're paying this much tax. You are better off. But people, when they are employees and they're contributing to their RSP and they're claiming childcare expenses and they've got medical expenses, tend to have tax refunds. Whereas in retirement, you tend to have tax owing. And people miss that it's less percentage tax on their income. And that's why RSPs make sense. If you can put money in, ideally when you're in a high tax bracket, withdraw it when you're in a low tax bracket. Even if you're withdrawing it when you're in a comparable tax bracket, the biggest win is contribute in a high tax bracket, pull in a low tax bracket. Most people during their working years will have a higher tax rate than when they retire. RSPs for the average Canadian are the best and easiest tax deferral opportunity out there. So I'm very much in favor of RSPs. I think all the hate that RSPs get is misguided. So
What do you say? When I do my tax videos, I'll sort of say in the order of contributions. I'll go, if you're a younger person, you're in a low tax bracket, just try to max out your TFSA, get that thing
yeah.
started. As you get into a medium and higher tax bracket, then look at prioritizing your RRSP for those tax deferral benefits. That's just sort of the basic advice. What do you think of
Yeah.
that setup?
Yeah, no, I think that makes a lot of sense. Most people early in their career are going to have a lower tax bracket, so RSP contributions are less enticing. Your RSP room carries forward. You can take advantage of RSP contributions later. TFSAs are also more flexible. Again, I alluded to younger people having money that they need for various purposes that is not retirement related. So TFSAs can be flexible in that regard. You can even contribute to a TFSA in your 20s, withdraw in your 30s, and contribute to an RSP at that point when you're in
Yeah.
a higher tax bracket. I think the only thing that makes it a little more complicated is if you're saving for a home and you've got the opportunity to contribute now to a first home savings account, an FHSA. That's the one case where if somebody had money they were absolutely going to be using for a home down payment, I could make a case for an FHSA because it's kind of use it or lose it. Once you buy a home, you can't take advantage of those contributions, which are tax deductible, and then the withdrawal to purchase an eligible home is tax free. So it's kind of like this RSP TFSA hybrid, in that it's like an RSP on the way in, tax savings. It's like a
Yeah.
TFSA on the way out, tax free withdrawals. That's the one sort of difference maker that I think somebody needs to consider in all those accounts.
It just feels like a good problem to have. You have too
More
many
choices,
choice. Like, I
Yeah.
don't know what they're doing in the States. I'm not too familiar with tax law there, but I've
Mhm.
talked to a couple of CEOs in the States, and the tax treatment, especially on investments, is not that favorable in the States. They have long-term versus short-term gains and all these
Mhm.
weird little things that we
Yeah.
don't have here in Canada. We have the FHSA, we have TFSA, we have RSP. It's like, hey, you're kind of, I feel like you could, I had this thing I was talking to someone, I realized when I did the math, I worked at McDonald's when I was 15 years old. And I realized if I just kept I've been hustling hard since I was 15 doing all this stuff. But I realized I could have just stayed at McDonald's, kept depositing my paycheck into my TFSA. And at this age, 40, been completely fine, well off,
Yeah.
had a massive TFSA, put some in my RSP as well. I would have been financially fantastic, never leaving McDonald's, just by those accounts that Canada set us up with, as long as that's financially responsible. Which brings me back to, let's get back to financial responsibility, because a lot of financial planners I talk to say when they talk to clients, it almost becomes less about invest this, and it's more about the psychology of investing, of like,
Yeah.
hey, are you keeping expenses lower? What are you spending your money on? Uh, what are some common traps because I don't know the age range of your clients, but let's say people closer to retirement, what are the traps they fall into that kind of compromise them financially that they could avoid?
Hmm. If you think back to being a 15-year-old working at McDonald's, your splurge was probably a Big Mac, right? And I think that's one of the
That's right.
challenges that when I think about it too, you live a simpler life when your income is lower and when you're younger. And oftentimes as you get older and you've got more cash flow, your spending increases with it. And that's where people can sometimes get into trouble if they've got lifestyle creep, if their spending rises lockstep with their income,
Yeah.
especially if they don't save enough for retirement. Because you could have a lifestyle that's based on spending most of your income. And if you haven't saved very much, Canada Pension Plan, old age security, and a little bit of savings isn't going to take you very far in retirement. So sometimes we see people that just they've lived too good a lifestyle. They put too little aside for the future, and it makes it hard to retire, or it makes it hard to retire as early as they want. They may want to retire at 55, but you crunch the numbers, you do the math, and you say, well, you need to work until you're 70, or you can just spend 50% less money. And a lot of times people are like, nah, it's not going to work. So I think the earlier you can sort of start on the path of, retirement planning, whether it's on your own, whether it's with a professional, the sooner you can see the trajectory that you're on. And a lot of people are better off, or they're going to be better off than they think. So you meet people that are the other way. They think they need to save. I'm never going to be able to retire. And you show them, actually, the math looks pretty good. Like live a little
Yeah.
bit, go on an extra vacation. It goes both ways. And whether you're saving too much or saving too little, the sooner you know, the better. I think there's a
Yeah.
benefit to that knowledge, right? As opposed to just sort of blindly wondering, and okay, I'm 63, I got a severance package, I'm going to make it work. Well, are you?
Yeah.
What could you have done 10 years ago or 20 years ago?
Have you ever fallen into those traps? Like, we're talking about lifestyle inflation. You said you got teenagers. You're successful. All your work is going really, really well. So obviously your income is going up. Um, have you ever suffered from lifestyle inflation? Have you had to course correct? Because I know when I had
Yeah.
kids, I come from sort of a poverty mindset. I've had no money longer than I've had money, so I've always been
Mhm.
scared. I always had the problem of never wanting to spend money. Like, I would just, it's how I built wealth really fast too, because I was just investing everything and investing it. Like, I never spent money. This shirt, people know this. I've had this since I was a teenager. I'm 40 now. I'm dead serious, and
Love
I
it.
show people like there's a hole
Yeah,
right there.
yeah.
So like, but like I still don't spend money on myself. But since I had
Yeah,
kids, I spend a lot now.
yeah.
And even after I got married,
It's
my
worse.
wife spends some
It's
money.
worse.
Yeah, but where are you coming at this from? Because you are a financial planner. So are you just practical through and through? You've never had these problems, so you're more looking at it from the outside in, or have you suffered from one or the other?
No, no, I suffer both ways, to be honest. It's funny. I've got on my wall here, I'm sitting in my basement in Pickering. I've got this bowl from IKEA, and it's got a little chip in the bowl. And I can remember at the time a set of six bowls from IKEA was like $20 or something like that. And I remember agonizing over, do I get the $20 bowls or do I get the $25 bowls, when that $5 meant a big difference. So this one bowl with a chip in it, my wife gave it to me. She framed it to put it up there because I like it. I always kept it and I would use it for my shreddies, and just to
Yeah.
remind myself where it came from. And so there are things like that that I still have this weird poverty mindset as well, where I'm kind of hesitant to spend money on certain things. Like I'll go and grab a sub or something like that, and I'll skip the drink because it's $3
Yeah.
for a drink, right? But then
Yeah.
there's other things where I will gladly splurge when it's about experience, when it's about health for my kids, education. I wouldn't even think twice.
Yeah.
So it's funny. And sometimes I do catch myself when I actually look at certain amounts. I'm like, really? Did I spend that much on that thing? Well, okay, it was worth it, right? So I
Yeah.
think that's part of life too, is you got to figure out what you're going to splurge on, what you're going to sacrifice on, try to find what works well for you. And experience is something that I like to, quote unquote, waste money on. But you'll never catch me buying a drink to go with my sub. I'll just go thirsty.
Yeah, we're identical there then. That's exactly where
Hmm.
I fall into the same camp as you. How do you feel about so that's like older people. How do you feel about younger people wasting money things on getting like an expensive lease on a car? Because I never really was aware of this problem
Yeah.
until my wife told me. I kept seeing people who were renting with super nice cars. And at the time when I
Yeah.
started dating, I drove a Toyota Yaris,
It's
really
like, what am I
crappy.
doing wrong? Why am I?
That's actually what I was like,
Right?
why is everyone doing better than me? It was like, I felt poor. I was like, oh, and I
Yeah.
owned a house. I drive a Toyota Yaris. I'm 6'3", so I barely fit in the thing. And I was like, what am I doing wrong? Everyone's got like an Escalade and stuff. And then
Yeah.
she's like, everyone's leasing. I was ignorant to the fact.
Yeah.
What is that? And it seems to still be a problem. Even back then,
Yeah.
it still is. What do you feel about people doing that? Is that more of a psychological thing again? Keeping up with the Joneses, trying to look cool? Like, I don't understand that one very well.
Yeah, yeah. No, look, I think it is. I think that's part of it. I think part of it is as long as you can afford the monthly payment. I mean, you can pay for everything monthly. You can order something on Amazon and pay over
Yeah.
six monthly payments, right, for something small.
Yeah.
So I think a lot of people have that mindset about what they can afford on a monthly basis as opposed to what they want over a lifetime. And I think that's the key, is you sort of have to work backwards and, set your budgets, not based on what you can afford. Something with a house or a condo, the bank might tell you you're approved for this much of a mortgage, but are you really? You might be
Yeah.
approved for it. The bank will give you that money. Can you afford it based on your lifestyle? Somebody can have three kids. Somebody can have no kids. Somebody can go on three vacations. Somebody can go on no vacations. That doesn't go on your application for the mortgage. That they're just looking at your income and they're doing the math. And I think people really need to do the math on their own. They've got to be careful about overcommitting to something like a car. A car's the worst because you can have 5, 6, 7 years of payments. You could be committing yourself to 5, 6, 7 years of saving too little, or splurging on more important things, splurging on things that would give you more fulfillment than driving a
Yeah.
nice car, which after 6 months, it's a used car anyways, so it's not going to give you the same fulfillment.
Do you talk to your kids about? You say your kids are teenagers. Do you talk to them about finances at all, or do they even know what you do?
Yeah,
Like,
I do, and it's interesting. I would say that going back to Finfluencers, my kids are on social media. They see stuff
yeah,
out there. They ask questions. They talk about things. I think they're more educated about money than I was at their age, and not because of their dad, because there's just more information out there. But I definitely talk to them about it, and I find it's a really fine balance, trying to encourage kids to make good financial decisions. But at the same time, I've seen people who are very wealthy, and have done well financially, who are miserable. And
yeah,
that's advice that I've really tried to give to my kids as well. Like, having enough money to be okay is important, But picking a job or a career because it's going to result in earning a higher income, you might be miserable but wealthy. So just be careful. Try to find the right balance. And I think that's really important. The best financial choice is not always the best life choice.
I was looking at some research about that because I think there's that number. I think a lot of us heard of like if you make over $80,000 a year, your happiness doesn't increase.
Hmm.
That's kind of true to some degree,
Yeah,
but they realize that people who are inherently kind of negative, no matter how much money they make, they're actually not happier after that
agreed.
80,000. It's for those after 80,000 makes no difference. And we've all met them. We met the
Yeah.
millionaires. We're like, oh man, that guy's not happy or gal. But then people who are inherently grateful and is happy, when they make over $80,000, they actually are happier. They're
Yeah.
actually better off. So like that. So like if you're someone, and I relate this back to when I got my first marketing job, I was making $35,000 a year, and I'll just sort of like at the bottom pole of this marketing agency. And I was never that stressed out first. I was young, but I moved in with my parents because it was in Victoria, BC. That's where they lived, and that's where the agency was. So I lived in my mom's guest bedroom. My expenses were low because I just drove her car. And then I just ate whatever food she ate, like roti and other Indian foods, right? So I kept a lot of 35, invested it. I had no financial stress, so that's how I did it. But I was also just really, really happy because I was like, I couldn't
Mhm.
believe someone was paying me money to learn marketing. Because
Yeah.
like you're basically like you have your education, but you're learning all these new skill sets. So I was just happy to be getting paid to learn. So
Hmm.
when I started making more money, it's kind of a roadmap for young people. My my lifestyle didn't inflate at all. I just kept behaving. I lived with my mom for as long as I could, but then I ended up moving back to Vancouver. But I went in, I moved in with roommates, kept costs low, eventually got my first home for super cheap, just stuff like that. But lifestyle was super, super low. And I was
Yeah.
always super, super happy because every position was always just teaching me more skill sets. I was always happy to just get paid to learn, get paid to learn. When I finally did start making real money, nothing changed. Like I
Yeah.
said, lifestyle hasn't. My lifestyle has not changed at all, other than the expenses associated with children and investments.
Yes.
And
Yeah.
investments make you money, right?
Yeah.
So I feel like that's the roadmap. Maybe having like a grateful mindset, just to be like, I'm happy to be
Mhm.
here. Like, this is
Yeah.
great. I got enough money to do stuff, and I'm not worried. But you can't really have that if you're living paycheck to paycheck. You're just kind of stressed all the time.
Yeah.
And so
Agreed.
like to like live below your means, I think would be the biggest thing. But I think that's hard for people, especially
Yeah.
with social media. Like your kids are on social media
Oh, yeah.
from an advertising standpoint, Jesus, I remember when I used to go like high school, Usher was a singer, like this
Yeah.
rapper singer. I'd only see Usher on MTV for like 1 second of music video. So I'd only do a comparison in my mind of how much cooler he is than me for the 5 minute music video.
Yeah.
Now, if I was on my phone, I'm a kid and my brain's about,
Constant.
I
All
would feel
day.
like crap.
Yeah.
I already had low confidence. If you just crush my confidence. And I would always feel the need to be something I'm not. I know myself, right? I would be completely manipulated. I feel like I'd just be like this really unhappy. I know myself. So, I don't know, what do you do as a, this is like not even investing. Maybe I'm just asking you because my kids are going to grow up in this culture.
Mhm.
How do you talk to your kids, deal with them in the social media? Like obviously, like they got you as a dad. They're gonna have common sense. They watch your behavior. Kids learn by watching, so I'm sure they know what's stupid and not stupid. But are there any conversations? Are there anything that even you look for, being like, because it's all craziness out there now on TikTok and all that
Yeah.
changes their brain chemistry in some ways?
For sure. Oh, yeah, absolutely. And I mean, conversations that we've certainly had around our house. And the one good thing is, I've seen the kids in some regards um, changing the stuff that they're watching on social media, like watching physics videos on
Yeah.
TikTok or YouTube where it's like, oh, okay. I mean, it's educational. I can get behind that or whatever. But, definitely we've tried to explain to them that this isn't real life and what you see on there isn't real life. It's one of the reasons that I'm not a big fan of social media and not on social media a lot because I know it's fake to a certain extent, particularly the Facebooks and the Instagrams and the happy posts and the things like that. There's some legitimacy to it, obviously, but you got to be careful about living your life based on your expectation of what other people are doing. It's that keeping up with the Joneses, but out there virtually as opposed to looking around in your neighborhood. And it's tough these days. There's just even more things that are mandatory expenses, or not discretionary. Like it's not a discretionary expense to have a cell phone when you're 10 years old anymore. And I hate to break it to you, but these days a lot of like 7-year-olds have iPhones
Yeah.
at school. So it's coming up on you. So I think that's the challenge. There's a lot more required expenses. You know, how required they are is a whole other thing, but it's one of the reasons that life's tough for young people, and why, you know, you can have two people with good jobs working hard trying to save and get ahead, where it's very difficult to do so.
I'm going to tie this all together now, bring it all full circle, because basically what we're getting is comparison is a thief of joy. That's what happens.
Mhm.
And, before I let you go here, is it affects young people. Like I say, I come from advertising. I understand social media. I understand how social media is used to manipulate people into purchasing things and to feel a specific way, because I've been part of that. Like I've done that for companies. I know how that works. But as a 40-year-old who is a person who's done that earlier today, I'm an influencer. I'm looking at some Instagram post. I live in an older house, paid off, takes care of my family. I should just shut up and be happy. My expenses are low. Looking at this post of a person, maybe even like a couple years younger than me, 10 times bigger house, really beautiful. And I was thinking, I'm looking at like rental, like houses that maybe I can rent out for my kids. And I'm thinking, maybe I should just like upgrade my house. That thought creeped in for a second, right? I should just buy a nice house. I thought
They look
that.
happier than me. Wait a
Yeah,
minute.
they did actually.
No,
And they're
no,
like
no, no.
smiling, right? And it was like the big windows. I was thinking, maybe I should just do that. I'm like, I'm being too practical. I'm being too pragmatic. And then it seeped in. And after, like, I know everything about this. This is what I do for a living. I should know better.
Yeah,
And it got me. It got me for a second.
yeah.
I snapped. I said, shut up,
Oh, it
Gary.
happens.
You're literally, your life is easier because of the circumstances you created, because you're not upgrading. You're not doing all this stuff. All your money is going towards doing things. Shut up. Do your thing. Ignore. This is why you should uninstall Instagram on your phone.
Yeah.
Like, get off. Does that ever creep in your head? Do you ever still fall prey to that? Like, I kind of, it came out really fast, but I caught like,
Yeah.
if it's happening to me, it's got to be happening to other people, no matter what their age is, even if they're on Facebook, if they're older, stuff like that.
Yeah, for sure. No, it does. And I think you gotta check yourself. You have to stop. You've got to remind yourself what marketing and social media is. You've got to remind yourself what your goals are. And it's interesting, you know, you look at those studies you see of the happiest countries in the world, and you look through the list, and they're not the wealthiest country. Like you go down the list far enough, and you're like, wow, that's actually a relatively poor country, I think, but they're really happy there. So what's with that? Like if wealth doesn't necessarily result in happiness, and I see it in real life that, you know, I think if you have too little money, obviously it's stressful and it's difficult. If you have too much money, it's weird, but it can be difficult in another way, because there's this expectation that you should be buying dinner, you should be helping your kids out, you should be making better financial decisions, you should be, you know, giving more money to charity. And there's a happy medium somewhere in there. And I think it's really important for people to find it on their own. And it's particularly tough, I think, in big cities as well, where real estate's expensive, cost of living is expensive. It's a lot easier if you're living in the prairies, or you're living in the Maritimes, or something like that. But if you're in Vancouver, if you're in Toronto, if you're in a big city where life's expensive in the first place, if you also get caught overspending on discretionary things, living above your means, you're toast. You're not going to be able to save for retirement. You're not going to be able to afford the things that future you wants. And I think that's really important. You've got to delay gratification sometimes to be able to have things you want today and in the future.
I think that's the best way to end it, guys. Make decisions today that'll make the future you happy. Jason, thank you for chatting with me today. I really appreciate it.
Thank you. Thank you, Gary, for having me. Great conversation.